again, and welcome back to our video lecture for Chapter 7, Plan Assets and Intangibles. We're going to move on now to distinguishing between a capital expenditure and an immediate expense. So first and foremost, a capital expenditure, what this does, it increases the asset's capacity or it extends their useful life. Capitalized means that this cost is now added to the asset account and it is not expensed immediately. This is an important concept that you should know for your exam. So when we say to capitalize something, we're not recording an expense, we're actually recording an asset. So for example, we have items that are recorded as an asset for capital expenditures if you do like a major engine overhaul, or if you modify the body of a truck so that you can use it for a new use, or if you add to the storage capacity of a truck, that can all be considered a capital expenditure. Not to be confused with a repair and maintenance, which would be just ordinary repairs. Maybe you have to do the transmission, or you have to change the oil, replace tires, things of that nature. That's just ordinary repairs and maintenance, and that has to be expensed. So now we're going to move on to depreciation. And what depreciation does, it allocates costs to an expense over the life of the asset. So it's basically allocating the usage of the asset. And you're allocated against the revenue, so this helps earn each period. So that's why we're adhering to the matching principle. And depreciation expense is on the income statement. Make sure you know that. Depreciation expense is on the income statement. Accumulated depreciation is a contra asset account, and that is reported on the balance sheet. And as I mentioned previously, land is not depreciated. You will see exam questions on that, so please be sure to note land is not depreciated, but land improvements may be. So depreciation is not valuation, and it basically is not a cash expense. So depreciation is a non-cash expense, meaning you don't really spend any money. All you're doing is you're allocating the usage of an asset. So what you need to know, there's three things. You need to know the cost, you need to know the estimated useful life, and the residual value, also known as salvage value. Those are the three pieces you need to know in order to record depreciation. So I think I missed that piece. So the cost, the estimated useful life is basically how long you expect to use the asset. Years is the most common measure. We also have unit of output or miles or some type of measure. Years is probably the most common. And then estimated residual value is basically your salvage value, as I mentioned. And it's what you expect the cash value to be at the end of the useful life. So this is not depreciated because this is what you expect to get. Most commonly, we call it zero because that way that just lets us be conservative, and then we just say that it's zero. So we take the asset's cost minus the residual value, and that is known as the depreciable cost. So that's what you're going to depreciate. So we have three methods of depreciation. Straight line, which as we discussed is SLN as the Excel formula. We have units of production, which there is no Excel formula for. And then double declining balance, which DDB is the Excel formula to calculate these depreciation methods. And so then you see here we have the cost less the estimated residual value to give us our depreciable cost. And we have 5 years or 100,000 miles. So this is the information we're going to use to make sure that you add to your Excel template and ensure that your Excel template is properly formatted. So with the straight line depreciation, what we're doing is we're taking the equal amount of depreciation over each year. And then the depreciable cost, which we know is the cost minus the salvage value, that would be divided by the useful life to get in years to get the annual depreciation. If you take the useful life of 5 years and we multiply it times 12 months, you get 60 months, and then if you divide by 60, then you'll have the depreciation expense in a monthly figure. So for straight line, we're going to give the same information, and we see the cost is 41,000, and we're going to subtract it from the 1,000, and we're just going to divide by 5 to get 8,000. So this can be done in Excel with the SLN formula, and you can also make sure that this formula is entered in your Excel spreadsheet with the proper blue cells to show the data inputs and the formula in there. So the entry that we would do to record this would be depreciation expense. You can specialize it by truck, and accumulated depreciation. And as you see here, we have the cost. Here is our depreciable cost in Excel. And then we have the yearly expense of $8,000, and then every year our accumulated depreciation goes up by the $8,000. So this is a nice schedule to see what, and then you know we did it correctly, because if you have the $1,000, which is the residual value at the end, you know you did that right. If the salvage value is 0, that ending book value should be 0. And then you'll know that cost minus accumulated depreciation equals your book value. Minus accumulated depreciation equals your book value. So what happens is, as we use an asset, we add to accumulated depreciation, and accumulated depreciation is a contra asset account, and we know that accumulated depreciation has a credit balance then. So as we continue to add to that, then we know our book value decreases. So your asset's final book value is going to equal your residual value. So in our case, it would be $1,000. So let's take a moment and work through this example. So here we buy a sorting machine for $10,000 with a useful life of 5 years, and it has a residual value of $2,000, and it was purchased on January 1st. So our straight line depreciation, we take our $10,000 cost minus our residual value to get $8,000, which we divide by 5 to get $1,600 cost for your depreciation expense. Hopefully you work this problem out using your Excel template. Now for units of production. So in this case, we're taking a fixed amount of depreciation, but we're assigning it to a unit. And then we're taking the depreciable cost, which is still the historical cost, right, minus our salvage value. So that would be cost minus salvage value. Same thing we did for straight line, but now what we're doing is we're using our useful life in terms of units. And then the per unit depreciation expense, so this amount that we calculated here is now multiplied by the total amount of units produced. So let's work through that. In this case, we were told that we had 100,000 units. So we still have the same 41,000 minus the 1, but now we're going to divide it by 100,000 units to get 40 cents per mile and that's what they told us here that we're going to depreciate. So in this case, we have that we expect to drive this truck 20,000 miles the first year, 30 the next, 25 the next, and then during the third, and then 15 through the fourth, and 100,000 and 10,000. So this should equal hopefully about our 100,000 units here. That's our estimation. So this would be, see, now when you're in Excel, you may want to create this. This is a great Excel schedule to create so you can see and what the formulas would be. So now when we record this depreciation, right, we already figured this out would be 40%, so 40 cents. So we multiply it times the 20 to get 8. And then as you can see, 8 plus 12 is 20 equals 20,000. And then 20,000 plus another 10 equals 30,000. 30,000 plus 6 equals 36, and so on. So same journal entry, depreciation expense, and the same 8,000 in this case, just out of coincidence because the figures worked out. So lastly, let's talk about double declining balance. And here what we're doing is we are writing off a larger amount near the start of the life than we're doing in straight line, right? So here, this is called an accelerated depreciation method. Also, makers, modified accelerated cost recovery systems are used for tax. So double declining balance and makers, modified accelerated cost recovery systems are used for taxes. And what we do is once we compute the annual depreciation, we divide the asset's declining book value at the beginning of the year by a constant percent 2 times. So we're doing 2 times the straight line rate. So let's see how this works out. So here we have our formula equals 1 divided by our useful life, and then we multiply it by the 2. So in this case, 1 divided by 5 would give us 20%. So this is 1 divided by 5, and when we multiply it by 2, we're actually doing 40% depreciation. So we have our double declining rate here, and we have our cost. The thing you got to be careful is you want to make sure that this is $1,000. The biggest mistake that students make with double declining balance is that they don't go ahead and make sure they depreciate it greater than the asset cost. So remember, you can't depreciate it past $41,000 and you can't go below $1,000, which is our salvage value. So this is our rate for each one. And then here we're multiplying the rate by the period's beginning asset book value. So we're taking our 41,000 and we're multiplying it by 40 to get 16,400. And then we are taking, and you do that for each period, and I highly recommend you do that in this case using Excel. And then in your final year, what you're getting is only 4314, because at the end of year 4, your book value is 5314, as you see here, but you can't depreciate it less than 1,000. So that's where in the final years where you need to make sure that you didn't over depreciate the asset. So this column here in Excel really truly helps you in that regard. So now our double declining balance is a bit different because the first year's depreciation is using the full asset cost. And then the final year depreciation, we're kind of plugging the amount to make sure that we don't go past the residual value. So let's actually go through an example here, and with that same sorting machine that we purchased for $10,000 with a residual value of 2 for 5 years. So our depreciation, our rate is going to be 40%. Remember, 1 divided by 5 times 2 equals the 40%. And we have our cost going down here. So as we do this, 10,000 times 40% is 4. Then 6,000 times 40% is 6. And you see our book value is 36. And then 3,600. So we have now times 40% is 1440, so our book value is 2160, still greater than the 1,000. And in this case, when we take 2160 times 40, the only thing we can do is 160 because we have to make sure that we don't go below the $2,000 mark here. So please be cognizant of that. You cannot depreciate the asset below the residual value of the 2,000. So if you would have worked out the 2160 times 40% and put that number in here, this can never be, book value can never be negative. And then the following year, you wouldn't have any expense at all because depreciation expense because the asset was fully depreciated in year 4. So when we are comparing the depreciation methods, we have that straight line pretty much generates revenue evenly over time. So this is the one that meets the expense matching principle and expense recognition principle. The units of production is basically if your assets wear out because of use. And then double declining balance, if the asset generates more revenue early in life, then you want to make sure that you're expensing more of it early in life. So when we compare the depreciation methods, notice they all have to be depreciated for the total price, right? So our depreciable cost. And then how we do it, straight line is pretty forward, and then our units of production is based on production, and then our accelerated double declining, you see it's the first year depreciation is almost double. It's actually greater than double than our first year, and almost in each other instance it's greater. So be sure you note that. And then the patterns are basically straight line is a straight line. That's why it's called straight line depreciation, because you do the same amount every year or every month. Units of production fluctuate with the number of units produced, and accelerated depreciation is greater in the beginning years than in the lesser years. And you'll see basically the use. So straight line depreciation, as you can see, is more commonly used by 88% of companies. So we're going to stop right here and continue with our lecture in the next video.